If you did not like the way you felt in the fourth quarter, there's an opportunity now because we've had a run-up, and it's an opportunity to re-examine what you have not only in stocks, not only in bonds, but in cash. And so, Mark, there's a lot of things that people can do when it comes to this.
Can I just ask a rookie question? How quickly do things get out of balance?
Well, pretty quickly. I mean, when you're looking at the size of the moves, when you look at January and February and you look at an 11% return with those 2 months, it doesn't take long to get out of whack from your portfolio standpoint.
And Mark, remember, it's 19% from the day after Christmas Eve. So that's a really big
That's a big move. And you're really looking at two different things, right, Dave? I mean, you're looking at the fact that your asset allocation probably could rebalance. But the other thing you're hitting on is risk tolerance, because when you go back to the emotional piece of it, the ride that you took from September to December 31st, and then from there to now, how do you feel about your portfolio? How do you feel about your investments? And when we talk about portfolio, we're saying your 401k, your retirement plans at work, your IRAs, everything combined. When you look at the volatility of the markets over the last 4 or 5 months, you should really think about reassessing again your risk and your asset allocation.
There's a lot that goes into it, your age, your income tax bracket. I mean, a listener right now might be 70 or they might be 40, or we're not really sure, and therefore you have to go through this exercise, and it's really important. Derek, I heard you explain to somebody in the press this week that we're behavioral coaches, and that really is true.
Yeah, I think really the most important thing that Annex does is coach our clients with regard to the equity markets in conjunction with financial planning and tax planning and all the rest. And typically people get emotional, and that's one of the reasons we look at that fear and greed index. It's just a way for us to sort of objectively calculate where we are in the cycle. And when we were at 2 on Christmas Eve, that was clearly a buying opportunity. That was the lowest reading I'd ever seen. But now we're in the 70s, and that's a fairly high level. So it just gives me more reason to look at our portfolios, consider areas where we can opportunistically take advantage of this very strong advance, perhaps reduce risk a little bit, and perhaps change the nature of our fixed income holdings as well.
So that's a really good point, because we spend a lot of time talking about equities, but a lot of times the other part of that portfolio, if you're talking about a 60-40, that 40% is generally fixed income or bonds, as we like to call them. And there is a lot to consider when you talk about buying bonds, because, for example, if you buy individual bonds, there could be a move between the bid and the ask that you could drive a truck through.
Right. The spreads tend to be anywhere from 2 to 5%. So, typically we will use active managers in fixed income. They're able to buy greater size. They're much more efficient in the way that they approach, getting in and getting out of positions. And the other thing about fixed income right now, and this is something I think people really need to think about, is right now in a short-term bond, you can get about a 2.8% yield with a duration of only 0.26, which basically means if interest rates go up 1%, the principal value of that bond fund will only go down 0.25%.
When people talk about yields and what they're hearing as quotes, particularly on individual bonds, you have to ask, is it yield to call? Is it yield to maturity? There's a lot that goes into that.
Absolutely. I mean, we've had many, new clients come on board, and I look at the yield to maturity and what they've got. They're getting a 5% coupon, so they think they're getting 5%. But because interest rates have gone down so much, that price of the bond is well above par, which is about what they would get back if the bond was redeemed. So basically, they're getting 5%, but the value of that bond is going to decline. It's simple math into the end.
So, Mark, the chief benefit and where we started to go with this is rebalancing and making sure that you have some fixed income in there to kind of smooth out the ride.
Adding to the complexity, I mean, all bonds are not created equal, just like all stocks are not created equal. When you start thinking about your portfolio right now and rebalancing and taking that risk consideration at hand, you start to think then about sectors, and you start thinking about different parts of the world and different capitalizations of the companies that you're working with. Are you a large cap investor, mid cap, small cap? That's tough for a lot of do-it-yourselfers, is to try to make that balance in your portfolio between risk, construction, and then where do you want to invest beyond that in the asset allocation. So there's a lot of moving pieces. Now would be a good time, after this big run-up in the markets, is to look back right now, not only at your risk tolerance, how you feel about the portfolio, how you feel about investments, but then where are you invested, what's the capitalization, what kind of companies, and what kind of sectors.